Flowers in the desk. Merong user na eh. Tagal na naman, no? Yeah. Yun. Hello, traders, and welcome to the 8th lesson for this trading webinar series. So I'm glad that you are with us until the 8th lesson. So before begin, I would like to invite you once again to join us on our Telegram channel, and in the channel you will get the chance to have some basic knowledge, basic education about what is forex, and you will also get the chance to receive the latest news, the latest trends on the market, and as well as some analysis or technical analysis pattern that you can take on your own trade. Okay, and I would also like to invite you to please stay and don't go up to the last part of this webinar, because after the question, after I ask you my question, the uh, the one who will answer first, the one who will answer the correct answer on our live chat will automatically be the winner, and the moderator will check for that one. Okay, so the moderator will be like the judge for us to see if you are the person who answered my question right. Okay, so and I would also like to invite everyone to please uh, click the click this link, or register on this link. So if you go on this link, you will see this button which is saying take part. So just click on this one and you may see this link inside our Telegram channel. So I tried to paste this on the YouTube live chat, but unfortunately YouTube isn't allowing us to paste links on their live chat. So what I advise you to do is to join our Telegram channel. Then you may see this link. Then just click this take part button for you to have this training certificate, the 100% bonus on your account. And of course, we will first draw the raffle for the person who answered my question last time, and the one who will win today will have the chance to get the $100. And today is your last chance to win this prize. So what I advise you to do is to stay up to the last part of our webinar, because after I ask you my question, the first person who answered correctly will be the winner, will automatically be the winner, and our moderator will be the one who will look for that one. Okay? And of course, after this webinar, I am sure that you have your own action plan or your own trading plan after what you've learned so far from this webinar. Okay, and I am also encouraging you to please watch our, especially to my fellow Filipino traders, please watch our podcast. So you may see the podcast on our YouTube channel here. As you can see here,
May
it
resoluteness
is a
ka.
Tagalog webinar, or sorry, it is a Tagalog podcast. And I am encouraging my fellow Filipino traders to watch this podcast, and there will be a second episode for this one next week. Okay? So having said that, let's now proceed on our draw, on our raffle, and let's give some time for our other participants before we start this draw. So hello to Brian Dison. Welcome back. Good PM to you as well, Johnny De Vera Mangandi. Hello, Nadine Lost. Hello, Shailendra at 99. Welcome back. Good evening to you as well, Merbert Marturillas. Good afternoon, Dayo Shoyoye. Good evening to you as well, Flowers in the Desert. Hello again to you, Dodong Dapiton. Good evening to you as well, Raver Montoya. Welcome back. Hello, Faisan Khan. So thank you for confirming that you already received the $100 prize on your live trading account. Hello, Mew Whitey Gaming. Welcome back. Thank you for the kind words, Kaisan Kan. We were glad that we were able to bring value to you as well. And thank you for joining us on our entire webinar. Hello, Sam Daniel Damasco. If you haven't received the $100 yet, please keep in touch with the OctaFX team. They will reach out to you, or you may also send us a message on our website, or you may also send us an email. No worries, Mew IT Gaming. You can always watch the replay on our previous webinar. By the way, this is the last webinar for the series. So if you are with us since the beginning, then you will be given this training certificate. Good evening to you as well, Rajib Sharma, as well as Abdullah. Good evening to you as well from Nigeria, you Honoren. Hello, home sweet home. So we will raffle the 24 right answers last time. And then after this webinar, please stay with us and up to the last part, because the one who will answer my question first, or the one who will first answer the correct answer, will be automatically the winner. And it will be selected by our moderator. Good evening to you as well, Kuripo Takmoto, as well as Gemma Saribay. Hello, Shailendra at 99. So every one of you who are with us since the beginning of this series will be given the training certificate. Just keep in touch with our team, and don't forget to click this take part button from this link. Okay, so if you haven't done yet, then if you are not part of the Telegram channel yet, or the group yet, please join the Telegram channel for you to be able to see this link, because I can't paste it on our YouTube live chat. Hello, Julie Egloso. Welcome back. Good evening to you as well. Thanks for the kind words, Abdullah. And we hope that we were able to bring the your your needed knowledge, or the strong foundational knowledge that all of you needs for you to be able to start on your trading journey. Good evening to you as well, Keb Martinez. All right, so let's start the raffle for the 24 right answers last time. So you may see again your name on the description box below, together with your number. All right, so let's start. Hello, Abdullah. For our next series, please keep in touch with our team, or you may also like to follow us on our social media pages, so that when the team announces for the next webinar, you will be updated. And you may also see it on our website, which is, of course, OctaFX.com. Okay, so 5, 4, 3, 2, 1. So there you go. The winner is number 23. And number 23 is Johnny De Vera Mangandi. Congratulations, Johnny De Vera. You are the winner for the day's draw. So please keep in touch with our team, and we will reach out to you to credit your $100 on your live trading account. All right. So once again, congratulations. And again, please stay up to the last part of the webinar, because once I ask you my question for the day, the first one who will answer my question correctly will automatically be the winner. And the moderator will see, or will look for that first answer. Okay? Good evening to you as well, Michaela Villarubia. So let's now start on our webinar today. So for today, what we are going to talk about is how to calculate entry and exit points, how to make an informed trading decision about when to make the right entry for your trade. So for example, you saw a good setup. So the question is, how to calculate entry and exit points, and when to put your right placement for your stop loss. Because from our previous webinar, I didn't teach you yet on how to look for the right placement for your exit point or your stop loss, but today we will cover that one. All right, so to begin, so what we have right here is no matter which market you trade, whether you trade stocks, forex, or futures, each second the markets open are now provides an opportunity for us to trade. So we all know this, but not every second provides a high probability trade, right? So this is the problem for most traders because there's no high probability trade that is appearing always, right? Or there's no high probability trade that is always appearing on the market. So that's why we need to have the best context on when to enter and when to trade with the right or with a high probability setup. So in a sea of nearly infinite possibilities, put each trade you consider through a five-step test, so you'll only take trades that align with your trading plan. So not every trading opportunity out there is good to trade, or it isn't good for us to take every setups, because most of the time the market is in just consolidation, or it is just moving sideways, right? And um, if you apply these 5 steps, whether you're a day trader or a swing trader, then you will benefit from this one. So the first one is the trade setup. Of course, we all know how to look for a trading setup. We all know the CEST. So C stands for condition, entry, C for condition, and E for entry, S for stop loss, and then T for target. So later we will cover this one. And then the second one is the trade trigger. So once you saw a good opportunity to buy or to sell, then you shouldn't think twice. Just just go with the trade, and then put your stop loss for you to be able to protect your money and for you to be able to manage your risk, and then look for a price target and then the reward to risk ratio, or the risk to reward ratio. Okay, so for us to look for that on the live chart, so let's see if we can spot one. So here, for example, on the Aussie dollar, we have the 5-minute time frame. As you can see here, the price, if you remember our lesson from our Darvas box lesson, so we have a Darvas box right here. So this is what this step 1 is saying to us. So the first is the trade setup. Okay, so for us to be able to have the best context on when to enter a trade, we should be looking for the best possible trading scenario, right? Because as we can see here, we are on a downtrend, which is good. So, but this isn't happening all the time. So sometimes the market is just going nowhere like this. So if this is the case, then we don't have the trading setup, or we don't have the condition for our CEST. But in this case, we can see that we have the right context, which is a downtrend. So once you saw that the price is making this pattern, then all we have to do is to look for the proper trading setup, which could give us the high probability win rate, or the high probability that the price could win, or could go on our desired direction, right? So once you saw that you have the right context for the chart that you are looking, so let's try to change it with the euro dollar. So for this one, as we can see, we are on a downtrend, right? But as you can see here, the price is just consolidating after reaching the support. So in this case, we don't have a clean structure. And if this is the case, then we don't have the trade setup. So this is the importance of looking for a trade or looking for an entry. Because if you want to have the best entry for your trade, then you should look for the best trading scenario, or for the highest probability that the price could give us, which is a clean chart. So if this is the case, then we all know that this is not a good looking chart because it is just moving sideways. As we can see, the price broke this previous high, then it went back down, and in this case, we are just moving sideways. We are still on a downtrend, right? We are still on a downtrend, but the price isn't giving us or isn't doing a good structure level, unlike what we have here from the Aussie dollar, right? So for the Aussie dollar, we can see that we are down, and then we can see that we have a best setup here, which is a Darvas box. And then as we can see, after the price breaks this level, so let's say that we put our entry here from the breakout of this candle. So let's say we are just right here, then we saw that the price breaks this level. So other traders are not considering this as a strong breakout, but for the sake of example, let's say that we took the sell trade, and we can put our stop loss. So let's say above this recent high, or above this structure right here. So all you have to do is to put your stop loss near or above this structure level, and then as we can see, if we are aiming for at least 1:1 risk to reward ratio, then we can see that we won with this trade. But as we can see, the price still tried to go up, and this is normal in trading. So don't panic if you saw that the price is going against you. So don't panic. Just trust your analysis, because we all know that once the price is on a downtrend, there's a high probability for that trend to continue. Okay? And for the second thing is for the trade trigger. So in this case, the trade trigger, of course, is the breakout, right? So it is up to you whether you want to trade breakouts or pullback. So in this case, we took the breakout trade. So let's just remove the drawings for now. So for example, we are seeing, or we saw that the pattern for the Aussie dollar is giving us this Darvas box again. What you can also do is to wait for the price to break this level. So this is our resistance zone. And then if you don't like trading with the breakout, what you can do is to wait for the pullback for a possible continuation to the downside. Okay? So that's the two setups, or the two trade triggers that we can use. Okay? So now the question is how to manage stop loss and take profit level. So for us to manage the stop loss and take profit level, it is a very, very important skill to learn for any trader looking to succeed in the financial markets, because if you are not putting a stop loss, then you might suffer blowing your entire account because the price is volatile, right? We all know that the price, whether you trade stocks, crypto, or forex, the price could go against you, and the price could go. So let's say we took a short trade here, then the price goes up to this level. So imagine without putting your stop loss, then you may lose your entire account, and you may blow your account, and that's the reason why it is an advisable skill to learn, or to know where to look for a better placement of your stop loss, right? So the first one that we need to consider is to understand the market, then determine your risk tolerance, then of course set a stop loss, and then the fourth one is to, if you want to go with the trend, you can consider trailing your stop loss, and then for the fifth one is to stay disciplined, because not every trade will win, right? So the first one is to understand the market. So we all did it here on the Aussie dollar. So again, the importance of structure, the price action structure is very important, because as we can see, we have a clean market structure here, which is creating a multiple 1, 2, 3 patterns. Then once the price goes from this level, or this level earlier, we all know what happened here. We have a Darvas box setup, and then we saw that the price breaks this level, this bottom of the box, and then we saw that we won with that breakout trade. And then if you are a pullback trader, then you should wait for the price to pull back into your previous support that may turn into resistance. Okay? Unlike what we saw from the euro dollar. So this the trend for this market is down, but as we can see, there's no clean market structure right here. And this the price of this market or the price of the euro dollar is just consolidating. All right? So that's the first one that we need to consider to understand the market, understand what you are trying to achieve on your trade. If you want to buy, then you should look for an uptrending market. If you want to sell, then you should look for a downtrending market. Always go with the trend because if you go against a trend, it is like surfing against the water. And of course, determine your risk tolerance. So a lot of traders are comfortable by taking 3% per trade. So imagine losing a trade, which will cost you 3% of your account. So for other traders, it will give them an uncomfortable feeling. But for some traders, it is convenient for them or it is okay for them to lose 3% per trade. So all you need to do is to determine your risk tolerance. Other traders are just trading 0.5%. But the general rule in trading is to just risk 1% of your account. So this is very important because let's say you are trading or you are risking 10% of your account per trade, then you lost 3 straight in a row, then that means you will be down 30% of your account, which is very painful, right? And if you are seeing that your equity curve goes down from this level, then it immediately goes down negative 30%, then it will be painful and it will be very hard for you to stay disciplined. Okay, so it is very important to determine your risk tolerance. So know yourself if you are comfortably losing, or if you are comfortable losing 1%, then stick to 1% per trade. If you are comfortable losing 2% per trade, other traders are doing that as well. Then just be consistent on your trading, on your strategy, because if you are constantly changing your risk, so let's say you only took 1% risk right now, then you won. Then after winning, you feel excited, then you increase your risk. You increase your risk to 2%, but unfortunately, the market goes against you. Then imagine after winning 1%, then you will lose 2% on your next trade, which is not a good idea, isn't an ideal scenario, right? So this is very important because determining your risk tolerance will be the most important thing for you if you want to trade for a long term. Okay? Because always remember that we should always think long term. Don't think that you can double your money in 2 days, in 3 days. Always think in long term, right? Always think that you are trading from January to December. Don't think that from January you will only trade up to February. And then after 2 months, you are expecting to make 500% return on your portfolio. So that's not the reality in trading. And a lot of traders are suffering from false expectation. And that's why they are just quitting. They can't stay disciplined because they can't manage their risk. So that's why it's very easy for them to just quit. Okay. And the third thing is to set your stop loss. And this is where we can use our the right placement for our stop loss. So let's say again, we saw that the price is creating a Darvas box right here. And then we put our target or our entry here. So let's say we took a sell on this breakout candle. So the question now is when to or where to put your stop loss. So this is the dilemma of some traders because other traders are just putting it right here. After taking a sell trade here, other traders are just putting their stop loss just near this support. So remember, this level is our support zone. So let's say after seeing that the price is breaking the support zone, they will took a sell trade from this breakout candle, and then other traders don't know where to look, where to put their stop loss, right? So if this is the case, then we should use our ATR indicator. So as you can see here, I have my ATR indicator above. Hello, Faizan Khan. I am very much all right. How are you as well? Thanks for asking. So if you want to uh, set up your ATR, so let me just remove it for now. So first, click the indicator and then type ATR. Then once you saw that this average true range appeared, all you have to do is to click it, and then you can see it below. So I prefer putting it above like this. Then I prefer changing the color of my ATR to orange. Right? So once you set up your ATR like this, then what you can do is to, let's say we have a sell entry here. So all we have to do is to hover our mouse on our entry candle, which is the breakout candle from this Darvas box setup. So as we can see here on our ATR, if you hover your mouse on your entry candle, we can see that ATR um, is on a 0.00043 ATR. So that means this the ATR is calculating the volatility of this market. So the settings for this ATR is just the default setting. So let's see. So we have a 14 length right here. So what that means is that the ATR will calculate or will compute the last 14 candles for this market or for this pair. So as you can see, this is our last 14 candles. So beginning to our entry candle up to this candle. So this is the last 14 bars, or this is the last 14 candles that the ATR computed. So we all know that this candle has 0.00043 ATR, which is a 4.3 pips. Okay, so once you identify the ATR, so what we can do is to look for our price range tool. So you may see it here, price range tool, and then go above your entry candle, and then just copy the value of the ATR, which is 0.0043, like this. All right. So once you know where to put your, or once you analyze, once you identified where is your ATR, you can put a line into it like this. And then this could be your ideal placement for your stop loss, like that. All right. And then as we can see, it is the same placement like what we did for an example earlier, which is above the structure from this previous candle. Okay. So as we can see, we have 7.3 stop loss right here. We have the 7.3 pips for our stop loss. So this, after identifying how many pips or how much pips that we have for our stop loss, then we can start trading with it. All right. And then what we can do is to just aim for at least a 1:1 risk to reward ratio. And as we can see, following this trade, we already won with this trade with this red candle right here. All right. So again, what we did is to understand the market. Okay. We understand that the price for the Aussie dollar is going down. And then we saw that the price is giving us the Darvas box pattern. And then once you saw this, all you have to do is to wait for the breakout. Or if you are a pullback trader, then you should wait for a successful breakout and then a pullback. And then the second thing to remember is to determine your risk tolerance. So if you are okay losing 2%, then you may risk 2% of your account. But the general rule for trading is to risk 1% of your account. Then once you saw that the price breaks the bottom of the box, then you may enter the trade, and all you have to do is to set a stop loss. And again, what we can do to look for a better placement for the stop loss is to use our ATR indicator, hover your mouse on your entry candle. Then once you saw that the price or the ATR is giving us the value, all you have to do is to copy it using the price range tool like that. So assuming that the price assuming that the ATR says that you should put 9 pips on your stop loss, then we can follow it like this, or we can follow uh, that ATR or the value of the ATR like this. Then you can put your stop loss right here, and then it is up to you whether you want to look for a 1:1 risk to reward ratio. All right, so that's how we can use the ATR indicator for us to have an objective way on finding a better placement for our stop loss level. Okay, and what we can also do is to consider trailing our stop loss for us to ride with the trend. So for example, we saw that the price breaks this level. So let's draw the box again. So let's say that the price already breaks this level, then our stop loss is just above this last structure. Then we can see that the price goes on our favor up to this level. Then the price is now pulling back. So what we can expect is, of course, for the price to make a pullback before continuing to go down. So if this is the case, let's say that this happened. So, and then let's say that we have our stop loss here. So what we can do is to, once the price breaks this potential support right here, what we can do is to put our stop loss at break-even level right here, so that the trade will be risk-free. And then as the price goes down like this, then we can put our stop loss down here. And then once the price goes down, we can put it on this level. As long as the price keeps going down, then we can follow the price using the stop trail or stop loss trail like this. And once you saw that the price is creating a structure like this, then you can consider taking your profit once the price breaks this recent lower high right here, because we all know that this is a change of character and there's a chance for the price to make a reversal once this happens. Okay, so that's how we can combine all of these things together. So first again is to look for a proper or a clean chart. Once you saw that the structure is clean, then you may look for a trading opportunity or for a selling opportunity in this case, because we are on a downtrend. Then once you saw that the price is breaking your box, in this case we have a Darvas box right here, you can take a sell trade on the breakout candle. Then for your stop loss, you should use an ATR like this. Then once you saw that the ATR is telling you to put let's say 5 pips, and pull out your price range, go above your entry candle, and then make your price range up to 5 pips like this. So as you can see, we have 5 here. Then put your stop loss right here on the placement of your ATR value. And then what you can do after that is to, if you saw that the price is going down, then you may now place your stop loss on your break-even point. And then once the price goes down again, you can put it right here. And if the price keeps going down, then you can trail your stop like that. Then as you can see, we have a possible reversal scenario here. Then you can exit your position and you may take your profit once this price action happened. All right. We can also see some patterns like a double bottom like this before going up. So if this is the case, then you can put your stop loss right here. Then once you saw that the price is finding it difficult to break this level, so let's say that the price is consolidating from this level and it is making a consolidation. So we all know that this is a Wyckoff theory, right? Once we saw that the price is just consolidating after a long markdown or a long downtrend, we saw that there's a chance for the price to do its accumulation phase right here. Then what you can do then is to exit your position right here once the price breaks this level, or you may also exit your position once the price touch the support again. So this is subjective. It will be up to you whether you want to exit your position or if you want to wait for the price to break this previous high that the price has created right here. All right. So that's how we can combine all of these things together. And of course, um, for the fifth step or the number 5 for this list is to stay disciplined. So it is very common for us to see a losing streak. For example, we have Darvas box right here. Then let's say you took a sell trade here, you put your stop loss here, then you are aiming for 1:1 or you are looking to trail your stop loss. But let's say, unfortunately, instead of continuing to go down like this, let's say the price went up and it reached your stop loss. So if this is the case, then you will lose that trade. Then, for example, the price continued to go down again, and then it gave us another opportunity to sell a breakout right here. Then, unfortunately, the price went up again. So if you are experiencing this losing streak, always remember to stay disciplined, because once you feel emotional, then it could be the start of your downfall, or it could be the start of you losing your account if you can't stay disciplined. Okay, so please remember to stay disciplined always, because market is volatile. We don't know what the price will do next. That's why it is very important to set a stop loss and to consider trailing your stop loss to enjoy much of your winners, because as we can see, it's happening right now, the one that we are talking about earlier. So if you saw that the price is now going down again like this, so after the price breaks the support, this recent support that we have right here, so let's say the price goes down like that, breaking the support, so we can put our stop loss right here, because we all know that there's a probability for the price to continue with its downtrend. Okay, so that's how we can combine all of these things together. And for our third point the question is when to be an aggressive and a conservative trader. And this thing is a pretty subjective topic. Okay, because other traders prefer to be conservative while other traders prefer to be an aggressive trader. So given the aversion to risk, most of the conservative traders, they follow low, moderate, end of the risk spectrum when they trade, and they also use combination of fundamental and technical analysis to make a well-informed trading decision about how they will trade, how they will treat their trade. So, for example, you are a conservative trader. So instead of just looking at the price action, and instead of just trading once the price breaks this Darvas box pattern, so most of the time, conservative traders will look for the news. So as we can see here, we can see that we have some important news right here. So most of the conservative traders tend to rely on the news, on the fundamentals, together with the chart, together with the price action, because they are fearing that once they put an entry on their price action pattern or on their trade, they are fearing that there could be a news that could give them a huge loss. So it is very important for them, for the conservative traders, to look for uh, the 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 news like this first before considering to take a trade. Okay, so that's how most of the conservative traders are doing it, while other traders don't like trading with a 5 minute time frame like this on the Aussie dollar, just like what I showed you. So what they prefer to do is to look for a higher time frame, which is the 4-hour time frame like this, and then they will look for a possible entry inside this time frame. So for them, for the conservative traders, they don't want taking on a huge risk. So for example, they saw that the price is breaking this Darvas box pattern. Again, they tend to rely on the news first before taking a trade. So that's how conservative traders are doing it, while other traders are looking for more information before taking a trade. So for example, you are a conservative trader and then you saw that the price is going down. Then let's say the price form a Darvas box right here. So for the for the aggressive traders, once the price breaks the bottom of the box like this, they will instantly take a short trade here. But for the conservative traders, don't they don't want to take an immediate trade like this. What they want to see is for the price to first create more information like a breakout buildup like this. So once the price created a buildup like this, so by the way, this is a breakout buildup. Once we saw that the price is creating low, then lower low, high, then lower high, then another lower high inside the box, inside our box pattern, then this is what we call a breakout buildup. So other traders or other conservative traders tend to look for more information like this before considering to take a short trade below here. But for the aggressive traders, they will instantly take a sell trade just after seeing that the price is breaking this this level like that. They don't wait for a build up like that. But for the conservative traders, it is very important for them to look for a pattern like this before considering to take a sell trade. Okay, so that's how conservative traders are trading. So it is up to you whether you want to be conservative or whether you want to be an aggressive trader. So let's look for a good example right here. So for example, we have a Darvas box pattern right here. Then as we can see, the price went down. So the price isn't breaking this low yet. So as we can see, it is still the price still fighting to go up. Then if you are an aggressive trader, then you may instantly look for a sell after the price breaks this level. But if you are a conservative trader, or if you want to be more safer than the aggressive traders, you may want to look for a move like this, then a breakout buildup like this before considering to look for a sell trade. And if we look on this pattern, we can see that that buildup happened right here. So as we can see, the price is making a lower high, and then we saw that we have a breakout buildup right here. And then for the conservative traders, this is what they want to see on the chart. So once they saw that the price is making a buildup, a breakout buildup, after the price breaks this level, so we have a breakout candle here. So this is a good trade for them. But let's say we don't have this buildup. So let's say that the price went up and then it immediately breaks this the low of this box. Then this trade is not good for them. But for the aggressive traders, they wouldn't think twice. They will instantly take a short trade here because this is a good trade for them. But again, for the conservative traders, they want more information such as a build-up like this. And as we can see, the price was able to break this the bottom of the box with this candle. So if you are a conservative trader, then you will likely to take this trade, this short trade. And if let's say you took a short trade right here, and all you have to do is to use your ATR, hover your mouse around the entry candle, and as we can see, we have 37.5 pips for our stop loss. So what you can do is to copy the ATR value above your entry candle. It is 37.5. So by the way, you can't go below 37.5 but you can't go above, or you can go above. So let's say you want to put 40, it is okay, it's all right. But if you go below, so let's say you just want 33, this is not a good strategy, or this isn't okay. Okay, so let's just follow 35.7, or let's say 36, something like that. Then put your stop loss on your ATR value, or the value of your ATR. And then what you can do is to look for at least a 1:1 risk to reward ratio like this. So again, risk to reward ratio is more important than win rate, because whether you uh, so let's say you want a high win rate, let's say you got 90% win rate, but every time that you are winning, you're just winning 0.5 or 0.3%. In the long run, that's not profitable. So other traders are just looking for at least 1:1 risk to reward ratio like this, while other traders are looking for the next support, which is right here. As you can see, we have our next support down here. And if we look for a support zone, we have this trading, or the support zone below. All right. So other traders are putting their target right here at the next support. So if this is the case, so let's say you want to trade like this, so you can enjoy a higher risk to reward, which as you can see, we have a 2.19 risk to reward ratio right here. Okay. So if you want to make this next support zone as your target, and that's very doable in trading like this. While other traders, so let's say that the price went down. So again, other traders prefer trailing their stop loss like this. All right. So that's why trading is subjective, because it is up to you whether you want to follow the strategy of one trader, or you want to follow a strategy of other trader. It is up to you. Okay. And for the last point for our webinar today is when to be an aggressive trader. So aggressive traders look for these three things. So they are open to more risk through the use of leverage or bigger position size, and they aim to generate quick profits through day trading. So they prefer day trading more than swing trading. So for swing traders, they tend to look for the daily time frame first. As we can see here, the daily time frame is forming a 1, 2, 3 pattern for the Aussie dollar. So if this is the case, then if you are uh, an aggressive trader, then you may look for your lower time frame for you to be able to capitalize on this move, which is the pullback. So we already talked about this before, because this pullback will give you a good selling opportunity on your lower time frame. So as you can see, this is the pullback that we have from the daily time frame. And if you are trading on your lower time frame, we can see that we have a lot of trading opportunities right here. And we can see that starting from the top before the pullback, we can see that the price created some selling opportunities for us. Right here, we have this Darvas box again right here. So for the aggressive traders, they prefer trading the lower time frames. Okay, and just like what we read here, they aim to generate quick profits through day trading, and they seek to generate bigger returns and beat the market performance as measured through the S&P 500 index. So S&P 500 index has an average of 10% per annum. So what aggressive traders want is to have a higher return than 10% per year or per month. They are aiming for at least 4 to 6% per month. And then if you compound this on a 1 year return, then 6% will give you 100% on your trading account. Okay? So if you want to achieve 100% per year, then you must aim for a 6% return per month of your trading portfolio. Okay, so that's how aggressive traders are working. They prefer trading on the lower time frame for them to capitalize on the market movement, like what we have here from the Aussie dollar. But for the conservative traders, again, they prefer trading on the higher time frame and they want more information before taking a trade. So for example, we have this is a good example for the Aussie dollar. So we have this previous resistance that could turn into support, and this is again our previous one from our 1 2 3 pattern. So if you are an aggressive trader, then you may instantly look for a trade once you saw that the price is reaching or has reached the support zone. So let's say that we are just right here, the price is pulling back, then you saw that the price reach your support zone right here. Then for the aggressive traders, they will instantly buy once they saw that the price reached the support zone. But for the conservative traders, they will look for more information such as a breakout to the upside. Like this, the price establish a high right here. So most of the conservative traders prefer trading the breakout of this high. But if you are an aggressive trader, then again you may look for an instant buy once the price reach this level. So something like that. Okay. Then as you can see, if you are aggressive, then the price went up before going down again. But if you are conservative, then you will not lose with this trade because you are waiting for the price to break this level before opening a trade. So let's say you are aggressive and you instantly buy once the price reach this zone, the support zone. So let's say that you bought into this level. So again, you will pull out your ATR like this, hover your mouse around this candle. So we have 18.4 pips. So you will likely put 18.4 on your stop loss, and then you will likely buy into this support zone. Then let's say you put your stop loss down here. And if you are the type of trader which is aiming for at least 1:1 risk to reward ratio, then as we can see, you already won with this trade. But if you are aiming for the next resistance, so we can see that our next resistance is right around here. So this is the resistance zone that we could use. While other traders are using their Fibonacci retracement, and they are looking for the 61.8 and the 78.6 Fibonacci level, and they are, for most aggressive traders, they are looking for this resistance to put their target like that. Okay, so if you are this type of trader, then as you can see, this isn't always happening because most of the time the market will respect the first resistance below here before reaching this second resistance above here, which is our Fibonacci retracement. Okay, so that's how you can make a trade, or that's how you can decide whether you want to be an aggressive or a conservative trader. While other conservative traders are using the trend line breakout as well. So this is what we learned from our past webinars. So now that we know that we are sitting on our support zone, we all know that once the price breaks this trend line, there's a probability for the price to go up like that for a possible continuation to the upside, because this is a possible continuation for the higher time frame. Right? So for the conservative traders, they will likely wait for the price to break this trend line before taking a long trade. Okay, so that's the main difference of how conservative and aggressive traders are trading. So if you are the type of a conservative trader, then you may want to look for a breakout of this trend line before opening your trade. But if you are an aggressive trader, then most of the time what they are doing is they are just looking for an entry candlestick pattern such as a pin bar, uh, an engulfing candle, or simply a doji like this. Or they also consider trading on a double bottom. Okay, but again, for the conservative traders, they prefer trading on the breakout before opening a trade. All right, so that's the main difference of conservative and aggressive traders. So what we learned so far is how to enter a trade using the best context. Again, we should look for the setup. If the price is showing us a clean structure, then that's a good trading setup. But if the price is giving us a dirty structure like what we saw from the euro dollar earlier on our 5-minute chart like this, so we saw that this one is acting like this earlier. So this is not a good trading opportunity for us because we want to look for the better setup. And then a trade trigger, which is a breakout or a pullback, and then put a stop loss, then your target and your risk to reward ratio. We also learned about the risk management, the your risk tolerance, as well as the trailing stop loss strategy. And we also learned how the conservative and aggressive traders are taking their trades or opening their trades. Okay. And if you are newbie, so by the way, the definition of stop loss is it is used to limit loss or gain in a trade. The concept can be used for short term as well as long term trading. And take profit level is it's a level in which a preset price traders close a profitable position. So take note of this. Okay. So having said all of those things, so let's now go on our Q&A session for today. So again, I want to invite all of you to please stay after this webinar because I will ask my question for you today, and the first one who will answer my question right will be the winner, will automatically be the winner for the $100 of your trading account, and the moderator, our moderator, will look for that person who will answer my question right, or who will be the first person to answer my question. Okay, so if you have some question, so please comment it or put it on our live chat before I ask you my question for today. Hello, Soloski Charles. So we are so glad that you enjoyed this webinar. So if you want to watch our past webinars, you may look on our YouTube channel. Then just look on the past webinars like this. So let me try to show it to you. So just go on our channel, which is OctaFX Broker, or you may also search OctaFX Broker together with my name. Then you will see my previous webinars right here. Okay. Then as you can see, this is my previous webinars, and I am also inviting every one of you to please uh, take the time to watch other speakers as well. They are also giving us some valuable lessons. Okay, so if you browse our channel, just go here and you may see the previous webinars that we already held from the past. Okay. Hello, Dayo Shoyoye. So, thank you for giving us the information about the Urian on the 1 hour time frame. So let's try to look at it. So for this one, we can see that the price is on an uptrend. So we have the fifth wave right here. So if you are looking for the Wyckoff theory, we can see that the price is still trying to go up right here. But if you saw that the price is struggling to make a huge breakout, so let's say the price breaks this resistance, then instead of continuing to go higher like this, so let's say after just breaking this like this, then the price immediately pull back, then this is a sign of a divergence. So watch out for that because if the price is giving us this short breakout like this, so let's say we have a short breakout, then instead of continuing to go higher, the price just pull back like this, then this movement right here is a sign of a divergence. So if you want to look for a buying opportunity on the euro yen, so we must wait for the price to make a huge breakout before considering to buy on this support zone like that. Okay, so I hope I answered your question right. Hello, Safar Abbas. So you may want to look for the economic calendar because if you are trading with the news, so there's a high chance for the price to go wild and the volatility will be much higher compared trading without any news. Hello, Abdullah. Let me try to look at the Aussie dollar daily structure, right? So here for the Aussie dollar, as we can see for the Aussie dollar, we have this 1, 2, 3 pattern. Then as we can see, the price is now reaching or sitting on the support, which is our previous one and our previous resistance. And our recent high is right here. So if you want to take a trade right here on the support zone, you can make this previous high right here as your target. Okay, let me know if I answered your question right. Yes, Johnny De Vera Mangandi. You can watch the replay of this webinar later. Hello, Josephine Antonio. This webinar is the last lesson for the series. So please keep in touch with us and you may follow our social media pages to be updated on our next webinar. And you may also look on our website to look for the upcoming webinars. Hello, Nelisa Ambalong. Yes, you can trade with the teachings that I am sharing with you on the stock market. Yes, UYT Gaming is right. We can also consider this a head and shoulder pattern. because we can see that the price is showing us some lower high right here. Okay. But if you remember our lesson, as long as we are above these previous two or the support below here, then we can still expect for the price to go up. But if the price validated the support down here, then the uptrend is losing its steam. But again, for the aggressive traders, you can take a sell trade right here if you want to capitalize on this movement to the downside, because there's a chance or a probability for the price to go down into the support down here. So that's how aggressive traders are trading. And if we look on our lower time frame, we can see that we have a downtrend. Okay, so if you want to look for a sell trade or a selling opportunity, we can see that this previous support could act as a resistance for us, right? And if this is the case, we can expect a pullback for this level before going down on our second support, which is right here. Okay. Hello, Vishal Kadam. So I will try to explain the imbalance, even if we are just, or even if I can only explain it a little bit. So for this example, we have this dollar yen. So I saw that the price is going down. Then I saw that we have some imbalance right here. So for the sake of the beginners, imbalance is where the price has uh, a structure like this. So let me just draw the pattern of the imbalance or imbalance pattern. So let's say we have a structure or a candle like this, which is going to the upside. As we can see, this candle at the bottom and this candle at the top. So let's say they have a gap right here. As we can see, this wick and this wick has a gap, right? So if this is the case, this is what we call an imbalance zone. And if you are asking about the recent imbalance, so we can look for the recent price action to look for this pattern. So in this case, on the dollar yen, so let me just delete these drawings. So as we can see for the dollar yen, the price is going down like this and it is creating lower highs and lows. Then once the price reach this support, we can see that we have an imbalance zone right here. So if we look for our imbalance, we can see that we have this. Let me just delete the drawings. So we can see that we have this candle, and then it was followed. It was followed by this next candle, and then it was followed by this next red candle. Then as we can see, the next candle right here didn't reach the last wick from this green candle that we have above here. So if this is the case, this is considered a demand zone as well as the an imbalance zone. So if you look into this level, this is where the price started to go up. So right after reaching this imbalance zone, we can see that the price went up. The price even created a breakup structure here, which is a change of character. So if you are holding a short position right here, so let's say that you have a short position right here or on the breakout. So let's say you took a breakout trade and then you saw that the price reached the imbalance zone. So you may consider taking your profit on the imbalance zone or right after the price breaks this level right here. All right, so I hope I answered your question right. So you may take entry on an imbalance zone if you can see a candlestick pattern, if you are aggressive. And again, if you are a conservative trader, you may want to look for a price action pattern, such as a breakup structure or a double bottom or a candlestick entry pattern. Hello, Josephine Antonio. I am using sometimes the 20 EMA like this. So this is a good filter for your trend following strategy. If the price is below the EMA, then that's a downtrend. But if the price is above the EMA, then that's an uptrend. And as we can see, if we combine trading with EMA together with price action, we can see that we have a breakup structure right here together with the breakup EMA. So this is a good breakout strategy, and we can also draw a box right here. So assuming that we bought here, and we can put our target from this resistance zone, and as we can see, the price already reached it. Okay. Hello, Mickey. Leverage is just the additional buying power of your capital. So let's say you have $100. So let's say you have $100. If you are using 1 is to 100 leverage, then your $100 will be multiplied by 100. And you will have times 100 buying power of your $100. Then you can put one lot, two lots, three lots, something like that. Because if you are using, so let's say something like 1 is to 50 leverage, then you may find it difficult to open at least one lot on your account size because your leverage isn't enough. But if you have, let's say, 1 is to 800 uh, leverage, then you may open up to 10 lot size just with $100 account. Okay, so that's how we can use leverage. We can use high leverage if we want to be aggressive and open bigger lot size. But remember that if you have a bigger lot size, then it is also a bigger risk for your account. Yes, Erica Pizarro, it is 20 EMA. Hello, Johnny De Vera Mangandi. So if you want to trade the London session, then you may want to look for, if I'm not mistaken, it is 3 p.m. Philippine time. And then it will end at around 9 p.m. And if you want to trade with the New York session, then if I'm not mistaken, it is opening 9 p.m. up to 4 a.m. Then there's four different sessions, the London session, Tokyo session, Sydney session, and the New York session. So it is up to you whether you want to trade on London, New York, or other sessions. Yes, Josephine Antonio. The settings for my EMA is 20. So let me show it to you. So here, the length of my EMA is 20. So other traders prefer trading with 50 EMA, but based on my experience, it is, or I am more uh, comfortable trading with 20 EMA. So this is up to you whether you want to trade 20 or 50 EMA. If you are a newbie, I I suggest using just the right leverage for your account. Hello, Visual Kadam. Or order block is also a good way for spotting trades. So for example, we have order block right here. So this is also a good support zone. This order block right here. So let's say the price pull back, then we can expect for the price to continue going up after reaching this order block right here. And we can also use uh, our Fibonacci together with the order block. And as we can see, our golden ratio, our golden zone, Fibonacci, is sitting with our order block. So this is a good combination using order block and Fibonacci zone. Just look for an imbalance together with an order block for you to be able to trade with those levels. And please stay with us up to the end of this webinar because the first person who will answer my question correctly will be automatically the winner. And the moderator will choose that person. Hello, Vishal Kadam. I'm sorry, but I'm not sure how many types of imbalance are there. But the way I trade with imbalance is just like how I showed you earlier. So for example, here we have an imbalance zone at the top. So this could be a good resistance zone for this price. So for example, the price went up to this level, then you can consider taking a trade, a short trade here, or you can, if you bought here below, you can consider taking your profit right here because we have an imbalance zone right here. So remember for you to be able to locate the imbalance zone, it is the last week from this candle before the breakout. So rem- if you can see the pattern, this is a Darvas box. And before the breakout, we have this candle. Then after the breakout, we have a candle right here. And as we can see, their wicks have a gap like this. So this is considered an imbalance zone that we can consider taking a trade on it. So other traders are putting a 50% level on their imbalance zone, and then once the price reach this 50% zone, and this is where the price could go down. Yeah, that the zone was already filled. So this is just for the sake of example. So if we look for other imbalance zone above, so let's try to look for other imbalance zone. So here we have an imbalance zone right here, which hasn't been tested yet. Hello, Solosky Charles. I suggest just study first, back test your strategy. Then, if you're a beginner, consider trading on a demo account first for you to be able to test your strategy. And then, once you gathered more information or more data on your strategy, then you can consider trading using that strategy on your live account. All right. So, last question before we go on my question for you today. Right. So, let's now move on for my question for you today. So remember, the first person who will answer my question correctly will be the winner for the $100. Okay, so the question is, it is a level in which a preset price traders close a profitable position. Again, it is a level in which a preset price traders are closing a profitable position. Right, so thank you very much for joining me for this entire webinar series. And I hope to see you everyone again for our next webinar. I'm not sure when will that be, but I'm hoping again to see you again for our next series. And if you want to have more webinars with me again, please consider uh, clicking like and share on this video. And then you may also subscribe on our YouTube channel and click the notification bell for you to be notified once we go live again. And once I have a webinar again, especially to my fellow Filipino traders, thank you for joining me for this entire webinar series, as well as some people here that I knew. I I I knew their username. Thank you for always being a part of this webinar, especially Home Sweet Home, Sir Venancio Junior Arenas, as well as Julie Agloso, as well as dodzkie, Dodong Dapiton, as well as Godstime, View YT Gaming. There's a lot of you, and uh, I can't thank you enough. And I am very thankful that you watch my entire webinar series. And again, I would like to invite you again to please click like and share this video and subscribe on our YouTube channel. Thank you again for joining me for this entire webinar series. And I hope to see you all again on my next webinars. All right, so this will be the last webinar for this series. And once again, I am Paul Mendoza, your trading speaker. Bye.